Okay, happy Friday, everyone. Welcome aboard. Welcome to our weekly Outlook webinar. This is Ilian Yotov, founder of allthingsforex.com and creator of the Quarters Theory. I also host a popular program called the All Things Forex broadcast. You're welcome to listen to the program on my website, allthingsforex.com. And when you get a chance, please check out my book, The Quarters Theory, The Revolutionary New Foreign Currencies Trading Method. Available everywhere books are sold. I would like to thank our friends at fx3.com for putting together and hosting these series of webinars. And what we're here to do today is to prepare for the upcoming trading week. I will give you the top 10 spotlight economic events that will move the markets next week, as well as we'll examine the consensus forecasts for the upcoming economic data, and we'll follow up on the major currency pairs and the latest trend developments there, and prepare for some of the trend development scenarios that could play out in the week ahead. As many of you remember at our webinar last Friday, we were discussing the events in Cyprus, and certainly Cyprus has been in the center stage of the market's attention, and that is going to continue in the week ahead, now that earlier this week the Cyprus Parliament rejected the proposed bank levy on savings deposits. Cyprus government is now trying to scramble another solution to this crisis, and negotiations are taking place as we speak. Cyprus finance minister went to Russia, came back from Russia. Now the Russian finance minister is going to Cyprus today. Parliament in Cyprus is now deliberating a 61-page new bill. The Eurogroup finance ministers, along with the European Central Bank and the International Monetary Fund, the so-called troika of inspectors there, said that as quickly as possible, the Cyprus government gives them the proposal for the new solution, the better. The European Central Bank yesterday issued a warning that they're going to stop the the liquidity funding for the Cyprus banks, which pretty much are going to be insolvent if the liquidity stops from the European Central Bank. The only way that they can exist at this point is with this type of liquidity provided by the Central Bank of the Eurozone. And so Cyprus now has an ultimatum to come up with a solution by Monday, which is March the 25th. And that is what I think everyone in the world is going to be watching, the new proposed solutions from Cyprus. Yesterday there were some discussions of this for the established that they may establish such a so-called fund that would a solidarity fund that could be one of the solutions. Obviously they're really hard working on a plan B right now, but there is nothing concrete that has been proposed. As I said earlier, the Parliament in Cyprus is deliberating this today. Even the bank levy is now being put back on the table, perhaps not touching the deposits below 100,000 euro, but be considering a bigger chunk, taking a bigger chunk of the larger than 100,000 euro deposits. On my program earlier this week, we have been talking about that genius decision, by the way, to take funds from depositors, the so-called levy on bank deposit savings. So we'll see what comes out later today and over the weekend, but without a doubt, Cyprus will be into the forefront of the market's attention. And if there is no solution that is workable solution that the Troika agrees to, then we could see the liquidity funding from the European Central Bank stopping, big defaults of the largest lenders there. Two of the largest banks there, the Bank of Cyprus and Laiki Bank, could actually be insolvent as early as Tuesday morning of next week, and that, of course, is the worst-case scenario. I think that there's going to be some sort of a workable solution, a last-minute solution, if you will, that's going to be proposed. Will it be accepted by the European authorities? And that's another question. So pay close attention to the financial headlines and the latest reports from Cyprus, because they are going to be very important as far as the future direction of the euro's exchange rate. Now, we're going to take a look at the daily chart of the euro-dollar pair. Earlier this week, we saw another reminder that current conditions in the euro area are not good as far as the economy is concerned. Growth is still nowhere to be seen. There still is a chronic contraction, as I have been saying it on a regular weekly and monthly basis on my program, the All Things Forex broadcast, and also during these weekly Outlook webinars. There is a chronic contraction in the Eurozone manufacturing and services sectors in all. Yesterday, the composite index, which is a combined index from the manufacturing and services sectors, and it actually not only stayed below 50, which is in contraction territory. As many of you know, when it comes to purchasing managers indexes, 50 is the dividing line between expansion and contraction. A reading below 50 means contraction. Well, not only the composite purchasing managers index in the euro area stayed below 50 for another month in contraction territory, but it was even lower than a consensus forecast, and it was lower than a previous month, contrary to a forecast for a little bit of an increase compared with the previous month. So that was a very disappointing report that came yesterday from the euro area, but it's not a surprising report because that has certainly been the trend when it comes to the manufacturing and the services sectors, and that is why I've been using the word chronic contraction, because in all but one of the last 19 months, this composite purchasing managers index in the euro area has been below 15 contraction territory. So no signs of improvement just yet. And now I wouldn't be surprised if the German manufacturing index actually dropped below 50, which is in contraction territory as well, and the French index had its worst reading in 4 years. So not only is the overall Eurozone index not showing signs of improvement, but now even the largest economy, Germany, who's doing much better than the rest of the Eurozone members, now starting to see the signs that there is conditions are not improving there either. And so the question is, who's going to lift up the overall GDP number for the euro area? Germany last year managed to lift up the overall GDP numbers from the euro area. So in the first quarter of last year, we didn't see the Eurozone actually contracting. But that, unfortunately, was not the case in the recent GDP reports. And it doesn't sound to me, at least, looking at the latest economic reports from Germany and from the euro area, that the Eurozone is going to be able to grow in the first quarter of 2013. So another quarter of a contraction is very, very likely from the Eurozone. And the reason why I'm talking about this in such detail is because I've been saying for the last, 8 months or so, that I have not been excluding the potential that the European Central Bank could be forced into offering additional monetary policy easing, including a potential rate cut. And that's why I'm still not excluding the possibility of that, because next month in April, we're going to start seeing the first estimates for the first quarter of 2013. In the U.S. and in the U.K. and other countries, the Eurozone first estimate is going to come for the first quarter GDP estimate from the Eurozone is going to come not in April but in May. But these are some things that we can look at and talk about, I'm pretty sure, in the next month or two. And if there's another quarter of a contraction there in the first quarter, the Eurozone does not return back to growth. And growth, as I've been saying, remains nowhere to be seen. Don't be surprised if the European Central Bank is starting to get a little bit more aggressive as far as looking for ways to create economic growth. And so that ultimately, if the market starts pricing expectations that there will be more easing by the European Central Bank, while at the same time, we're starting now in recent months, despite of what the Fed told us on Wednesday, is that they're going to continue their accommodative and ultra easy monetary policy and continue their aggressive quantitative easing operations. Each and every positive U.S. economic report as of the last, throughout the month of March, I would say, has been supportive for the U.S. dollar. And in the aftermath of the non-farm payrolls report earlier this month, I have said that there's an important shift that is occurring where the dollar now begins to benefit from positive economic data from the U.S., which shows signs of improvement in the U.S. economy, and the U.S. economy is looking better than the economies of, let's say, Japan or the UK or the Eurozone, which all of them were contracting in the final quarter of the year, and potentially all of them could be contracting as well in the first quarter of 2013. And this is why the dollar is becoming more attractive also, is because every positive economic report from the United States that's showing signs of improvement increases the odds that the Fed, and I've been saying that for months, the Fed is not going to quit cold turkey and stop quantitative easing, all of the quantitative easing operation, and start lifting interest rates. That's not going to be the first step towards tightening. But the first step that the Fed is going to take is going to be, I think, a reduction excuse me, in the size of the Fed's quantitative easing operation. And as long as the U.S. economic data continues to improve, then that raises the odds that the Fed could take that first step towards monetary policy tightening sooner rather than later. And if that is what the market's pricing in, then that ultimately makes the dollar more attractive. And from that type of perspective, one should watch the economic reports in the weeks ahead from the Eurozone and from the United States if one is trying to gauge the future direction of the euro as well. But when you combine all of these factors, the fact that there's uncertainty as far as the future of Cyprus, the third largest economy in the Eurozone still is without government. There's talks in the parliament with attempts in Italy to form a workable coalition. But unfortunately, there's still no government there. There's still no coalition. And even if there's some sort of a technocrat government that's being put together, as I explained in previous programs, then that is only going to be a temporary solution until the next election. So all of the uncertainty surrounding the future of Cyprus and the future of Italy, coupled with more signs of economic weakness from the Eurozone, all of these factors could come together in a combination as a catalyst to push the euro lower. Now, especially if that uncertainty leads to significant risk aversion and so forth and so on. Now, the euro is trying to bounce toward the $1.30 level as we speak. This is a very important price level in my quarters theory because it is a dividing line between two 1,000 pip ranges. In my quarters theory, I look at the 1,000 pip ranges between two major vol numbers such as $1.20 and $1.30, $1.30 and $1.40, and so forth and so on. In terms of price interest points, there's always a constant range there of 10 cents. So in terms of pips or price interest points, that's exactly 1,000 pip range. And between, I divide with my quarters theory these 1,000 pip ranges into four equal parts, or four, as I call them, large quarters of 250 pips each. And then I propose that currency exchange rates and prices in general do not just fluctuate in a random, chaotic manner, but they fluctuate in an organized manner in a systematic effort to complete these large quarters in moves from one large quarter point, targeting another large quarter point, in a systematic effort to complete the large quarters and ultimately to complete the entire 1,000 pip ranges. And so in my book, The Quarters Theory, I explained a concept which I call the 1,000 pip range transition, which is a very important development when it comes to these currency exchange rates fluctuations and price fluctuations in general, because when the market decides to shift the exchange rate from one 1,000 pip range into another, then that's a very, very important development. And if a trader, as I explained in my book, is able to recognize the importance of this event and look for the clues that I explain in my book, then a trader can pretty much, with a greater probability of success, predict the next move of 250 to 500 pips. And so that's the implication of what the euro-dollar pair is attempting to do now. The market's attempting to transition the euro-dollar exchange rate from the $30s into the $20s. And so far, the attempt has not been very successful. Obviously, the euro is bouncing back towards $1.30 today. It's overshooting $1.30 by a couple of pips in the trading session today. If the euro does stay below $1.30, and that's what I explain in my book as well, that would be a sign that the market may be willing to keep the euro-dollar exchange rate into the $20s. And if that 1,000 pip range becomes, the 1,000 pip range transition becomes successful, then that would open the door for the euro-dollar pair to not only complete the first quarter of this new range, which would be the large quarter between $30 and $27.50, but it could also open the door for the euro-dollar pair to complete, to target even what I call the major half point of the new 1,000 pip range, which will be the $1.25 level, or at least another very important level of support, which is the $26.59, which is a support from November of 2012. Now, the euro managed to establish support here. By the way, if you listen to my weekly Outlook webinars, you probably remember me talking about the first level of support here. It's a double bottom support, and it was established at the half point of the current large quarter between $30 and $27.50. The exact half point is $28.75. And so I'm sure it was just a coincidence that on December the 7th, the support level there, a double bottom support level, as you can see the identical low being established here the month before on November 28th and December 27th, December 7th rather, two identical lows at the $28.75. But as I said earlier, I'm sure that was just a coincidence that the half point of this quarter served as a level of support. And the euro tested that level and it tried to break, and actually broke below it. And 4 days ago this week, it established a new low at the $28.42. So this, for the time being, this is what serves as an area of support between $28.42 and a double bottom at the $28.75. It's about 30 pips of an area of support for the euro versus the dollar. So in the last couple of trading sessions, 3 trading sessions, the euro keeps finding support within that area. And now it's bouncing up to the $1.30 level. But if the euro does not manage to climb decisively above $1.30, and no workable solution is proposed in Cyprus, and the liquidity stops from the European Central Bank on Monday, then the worst case scenario would materialize, and we could see the euro really being pushed even lower, and that would serve as a catalyst, of course, for the euro to break below the support area between $28.42 and $28.75. If a workable solution is found and the euro never breaks below the support area, then we can anticipate that this 1,000 pip range transition from the $30s into the $20s was not successful on the first attempt. It's not unusual, by the way, for a 1,000 pip range transition to not be successful on the first attempt. As a result of an unsuccessful 1,000 pip range transition, we can see the euro-dollar exchange rate climbing back in the previous 1,000 pip range, above $1.30, and then it could start heading back up to the previous highs at the $1.31, $1.31.33, and then another high there was $1.31.60. And maybe even back to the previous support area, which was the large quarter point at $1.30.50. You'll remember $1.32.55 serving as a level of support here during these declines here for the euro. It was a weekly range that the euro established not too long ago, and the bottom of that range was $1.32.50. So I wouldn't be surprised if this bullish for the euro scenario plays out next week and a solution that everyone's happy with is found, and the euro will probably stage a relief rally, so to say, which could send it to $1.31.5, maybe even $1.32.5 area. A question here about the Aussie and the Kiwi. Unfortunately, the time on the program is very short. I only have 45 minutes to lay out everything that I feel is important for next week. And to be honest with you, we don't have very important data that's coming up or events from Australia or New Zealand. We had an important event earlier this week from New Zealand, the GDP report, which was a blockbuster report, much stronger, and the New Zealand dollar is definitely taking advantage of that. It's rallying versus the dollar. I said last Friday, if you heard my webinar last Friday, let me repeat that, I think that the New Zealand dollar it has a potential to move higher, but any move higher than what it is right now, which is 0.83.5 area, if it moves up to above 0.83.5, I think it could go to the large quarter point at 85 cents, 0.85 versus the dollar. However, I think that with each and every day that the New Zealand dollar strengthens further, the New Zealand authorities are going to grow more unhappy about the New Zealand dollar persistent strength. And that creates, although the finance minister in New Zealand said that there really isn't going to be an effective way to intervene and successfully weaken and prevent further strengthening of the New Zealand dollar, even if there was an intervention, even a verbal intervention attempt like the one we saw in February by the central bank governor of Reserve Bank of New Zealand, would actually cause the New Zealand dollar to weaken, at least temporarily. And so that's something to consider when one is looking at the Kiwi. I think it has a potential strengthening further, especially if risk appetite and investor sentiment improves next week, if a solution in Cyprus is found, or at least some sort of a technocrat government is put in place in Italy, that at least temporarily fixes things as far as the debt crisis in the euro area is concerned. It could reduce uncertainty, obviously, and it could improve sentiment, and that is going to be also positive for higher yielding currencies like the Australian dollar and the New Zealand dollar. They can gain further. On the other hand, however, be careful, because if the worst case scenario happens and causes more risk aversion, then that's going to be a major factor that could weigh on both of these currencies, the Aussie and the Kiwi. And that's, by the way, because another question is, what is the euro-yen implications? Is yen weakness unwinding? Well, based on what I'm explaining here for the euro, as far as factors that could weigh on the euro, they will be also applicable to the factors that could weigh on the euro versus the Japanese yen. For example, as you have noticed here during the Great Recession, as they call it, in the last few years, risk aversion and, generally speaking, risk-averse market environment has been beneficial for the Japanese yen. The yen has tended to strengthen in times like that. And so if there's more uncertainty and more risk aversion, obviously the Japanese yen could benefit from that. But what is happening with the dollar, with the Japanese yen, and I will talk about it in more details later on in this program, because there are two spotlight events next week that are coming from Japan. So let's move right along with the top 10 events for next week. The durable goods orders is going to be the first of the U.S. economic events for next week. This report is coming up on Tuesday, and it is expected to show durable goods orders actually increasing in the month of February. As I mentioned earlier when I was talking about the euro and the dollar and the conditions in the Eurozone economy and the U.S. economy, the U.S. economy is definitely looking better compared with the Eurozone economy or the economy of the U.K. or Japan for that matter. And so each and every positive U.S. economic report would continue to help the U.S. dollar, and that's what we need to be watching going forward into next week and in the weeks and months ahead. Durable goods orders could be the first in a sequence of upbeat economic data from the United States next week. So in January, durable goods declined by 4.9% month over month. In February, they're expected to increase by 2.5%. So that would be a positive report. House price index is coming up from Case-Shiller next Tuesday at 10 a.m. Eastern Time. And that report is expected to show home prices increasing in the U.S. by 7.4% year over year. That would be up from 6.8% year over year. And throughout this week, as many of you perhaps witnessed and noticed, we had a positive housing market reports. Housing starts, the existing home sales were positive from the U.S. Obviously, there's an improvement in the U.S. housing market. There's also an improvement in the U.S. labor market, and I've been saying all along that both of them are so closely related. And so labor market improving could help the housing market improving further as well. So the Case-Shiller House Price Index will be another positive report on Tuesday. Then we have the Consumer Confidence Index also on Tuesday at 10 a.m. Eastern Time. That is expected to show a reading of 70.3 from 69.6. It's not much higher, but it still remains a little bit higher than it was in the previous month. Provided there's no downward surprises, this would be another upbeat report. And then the new home sales are also due on Tuesday on our house market report. 430,000 is the number forecasted for February, compared with 437,000 in the previous month. So maybe a little bit less new home sales, but pretty much in line with the levels that were the previous month. That's going to take us to the main spotlight event from the United Kingdom next week, which is going to be the final reading of the United Kingdom's gross domestic product for the fourth quarter of 2012. The preliminary estimates already showed us that the United Kingdom's economy contracted by 0.3% quarter over quarter. So more than likely, that's going to be the outcome of the final reading. Another confirmation that the UK economy contracted again in the fourth quarter of 2012 after returning back to growth for only one quarter in 2012. First and second quarter, we continued the double-dip recession. First and second quarter in the UK, the double-dip recession continued. In the third quarter, the UK economy returned to growth. That caused a little optimism there, and then a new disappointment came with these fourth quarter preliminary estimates, and now the final reading on Wednesday is more than likely going to confirm that the UK economy contracted again. If the UK economy, and I've talked about this in recent months and weeks on this program, if the UK economy contracts not only in the fourth quarter of 2012, but also in the current first quarter of 2013, then that means that the UK is in a triple-dip recession. And despite the fact that the latest minutes report by the Bank of England, from the Bank of England's meeting earlier in March, showed that there was another defeat of the people, the three members, including the governor, Marvin King, at the Bank of England, who voted for an increase in the size of the asset purchase program, the Bank of England's quantitative easing program, I am still not excluding the potential for the Bank of England to do more easing, to increase the size of the asset purchase program, and not only that, but also as the minutes in February showed us, the discussion of actually cutting interest rates was also put back on the table at the Bank of England's Monetary Policy Committee. And so if conditions continue to deteriorate economically in the UK, if the Eurozone, which is the United Kingdom's largest trading partner, by the way, continues to not do well and continues to also be in a recession, and the UK now, with the preliminary estimates for the first quarter GDP, which will start in April from the United Kingdom, if they start showing us as well that the first quarter there was also a contraction in the UK economy, then I think that the Bank of England will have no other choice but to consider more easing, and ultimately that's not going to be a positive for the British pound when the market prices these expectations. Those of you who have paid attention to the pound-dollar currency pair would remember that this currency pair has been in a free fall here in the recent. That was all due to the expectations that the Bank of England will be forced into doing more easing, coupled with risk aversion and uncertainty about the event in Italy and now the events in Cyprus. The pound has managed to produce a nice little price correction here. It reached as low as $1.4830 last week, and now it has bounced up to this area that I was actually talking about that could be challenged during this price correction. That is the bottom of a 2-year range, which is in the vicinity of an important level in my quarters theory, which is the large quarter point at $1.5250. And to be exact, the actual price level that served as the bottom of this 2-year range was $1.5232. And on the way up, as I said in the previous couple of weeks, we could see the pound-dollar pair during this price correction where the pound is correcting some of its losses that were pretty significant losses. You can see that free fall that the pound had versus the dollar. Even broke below the bottom of that 2-year range, and then it broke below $1.50, reached the low to $1.4830, found support there, bounced back up to above $1.50, and now almost challenging that previous support level, which on the way up, as I explained, would be a significant level of resistance, $1.5232. Today's intraday high for the pound versus dollar is $1.5222. We're only 10 pips below $1.5232 resistance. And that's the first level of resistance, of course. The next one will be $1.5250, and the next one is $1.5277, $1.5276, $1.5280 something. There's a lot of numbers there in the vicinity of the large quarter point at $1.5250 that can be found as previous support levels for the last couple of years. That on the way up, they will serve as levels of resistance. And so there is an area of about 50 pips between $1.5232 and $1.5277.85 area that is going to serve as a significant area of resistance. And I'm saying that because we could see a bit of an overshoot above $1.5232. But be aware that the large quarter point is there at $1.5250, a little bit above it, $1.5277 to 85 area was also previous levels of support. That's why I'm saying it's about 50 pips of an area that may be difficult for the pound to overcome. And if that is the case, as we head into next week, and the pound is not able to break higher above this area of cluster, if you will, of resistances, we could see the pound being put under pressure again, especially if next Wednesday the GDP report serves as a reminder that, okay, the minutes are not showing that more members are calling for more easing at the Bank of England, but guess what? If the economy continues to contract if there is a triple-dip recession in the UK, with the government there not changing its course, as we also saw with the recent budget. Obviously, many of you perhaps know that in recent years, the United Kingdom's government is undertaking some of the most aggressive, largest spending cuts in recent history, at least since World War II. Obviously, that weighs on economic growth. It's a drag on economic growth. So who is there to pick up the slack? The Bank of England. And so the Bank of England could be forced to continue to pick up the slack, to look for ways to stimulate the economy, and ultimately that could lead to more easing, including a rate cut. I'm not excluding that potential. And if the market is expecting, and once again starts pricing in, expectations the Bank of England will do more easing, and if that is coupled with more risk aversion and uncertainty and deteriorating investor sentiment, the pound is not going to be immune from that. Those are going to be factors that weigh on the British pound, and it could resume that downward trend versus the dollar, which it managed to correct some of the losses after the correction is over with. If all of these factors come into play, and they start coming into play as early as next week, we could see the pound heading lower again and being put under pressure. Moving forward with the top 10 events, let's see here. Okay. We are going to also watch on Wednesday the pending home sales index, another housing report from the United States. It's a leading indicator of conditions in the activity in the housing market. The February pending home sales index is expected to increase by 0.5% month over month. That's going to be significantly lower than a 4.5% month over month increase in the previous month. But I wouldn't be surprised if that, considering the latest data from the housing market in the U.S., I wouldn't be surprised if the number is a little bit higher there. So if it beats the consensus forecast for a smaller increase than it was in the previous month, then that could be another upbeat economic report from the U.S. That's going to lead us to the big event from the United States next week, which is the GDP report next Thursday. And again, this is a final reading. The previous estimate, the first estimate, actually showed a disappointing contraction by 0.1% in the U.S. economy. The number, however, was revised higher, with the second estimate showing the U.S. economy growing very, very little amount, only 0.1%, but at least grew in the fourth quarter compared with the contraction in the Eurozone in the UK. These are not 0.1% growth is nothing to be proud about, don't get me wrong, but at least it was not a contraction. And so it's going to be interesting to see whether the final estimate confirms that the U.S. economy actually grew in the fourth quarter rather than contract. And looking at the consensus forecasts, Reuters consensus forecast at least, is expecting that 0.1% growth in the UK in the fourth quarter to be revised even higher to show 0.4% growth in the fourth quarter from the U.S. economy. So this report has the potential to once again show the differences between conditions in the U.S. and other economies. And if that indeed is an upward revision, as the consensus forecasts are pointing to, then that would be another upbeat economic report from the U.S. next Thursday. The GDP report from the U.S. is going to be followed by the main spotlight event from Japan next week, which is the Consumer Price Index. As many of you know, the Bank of Japan now has established in recent months a new target for inflation at 2%, moving it from 1% target level to a 2% level now. And Bank of Japan has committed to fight deflation, to create inflationary pressures until the 2% target is in sight. Well, unfortunately, the National Core Consumer Price Index in Japan is expected to show a reading of minus 0.4% year over year. This is compared with the January reading of minus 0.2% year over year. In other words, not only does the main gauge of inflation in Japan, preferred by the Bank of Japan, continues to stay in deflation territory below zero, but it's also heading in February further below the 0% level with a reading of minus 0.4. And what that means is that we could be seeing this index heading further away from the Bank of Japan's 2% level, which means only one thing. The Bank of Japan could continue its current monetary policies of aggressive quantitative easing and continue to keep interest rates at record low levels until that, as they have said in previous meetings, until the 2% target is in sight. Unfortunately, the target is not in sight, which means that the Bank of Japan could get even more aggressive. Now, earlier this week, the new governor, Kuroda, at the Bank of Japan, said that they may even consider buying longer maturity bonds and other measures, as long as the market continues to anticipate that the Bank of Japan will continue to be aggressive and maybe even get even more aggressive than it currently is, then that could weigh on the Japanese yen. So that would be the implication of the Consumer Price Index report, especially if the inflation gauge gets further away from the desired 2% target level. That could put the yen back under pressure, provided, and there always has to be a disclaimer when we talk about the Japanese yen, provided that the risk sentiment remains positive. If there's risk aversion dominating the markets next week, then the Japanese yen will more than likely benefit from such environment. If, however, there's a workable solution found in Cyprus, there's a new government workable coalition or a new technocrat government being put in place in Italy, then that eases concerns, causes more risk appetite, and ultimately the yen could be put back under pressure. But as I've been saying for months now, pretty much for the last 2-3 months, the dollar-yen pair is due for a more significant price correction. And we did see some, a better than previous corrections, a bit larger than previous corrections happening in the aftermath of the inconclusive election in Italy. But I still feel that the correction needs to be a little bit larger. Every little pullback, whether it's 100 or 200 or 400 pips for the dollar against the yen, has been met with more buying interest, which is understandable because it provides an opportunity for traders to reposition at lower price levels in anticipation for that strong bullish trend to continue. The trend, however, now, at least in this week, at least, has shown signs of possible exhaustion. And perhaps it is because the market is not confident enough to take on more risk until a workable solution is found for Cyprus and for Italy. But if those are found, I think that the market will be more confident and more traders will feel more confident into initiating long positions or yen short positions, so to say, and ultimately the yen decline could continue further, especially if the market continues to price in that the Bank of Japan and the government there will continue to be aggressive as far as reaching their goals, which is to create inflationary pressures, to spur economic growth, to weaken the yen more so that it could help exporters and so forth and so on. All of these tools are all of these factors is what the market's been pricing in since the latter part of last year, even in a drum roll, if you will, in the days and weeks leading to the Japanese elections, which, by the way, if you listen regularly to my program, the All Things Forex broadcast, each and every day on my program, we paid close attention to the latest polls from Japan. And in all of the polls that were coming, before the Japanese election took place. All of the polls were pointing to a landslide victory for Shinzo Abe, who is the new Prime Minister of Japan now. And he's been very, very vocal and very clear about his aggressive plans to fight deflation, to support economic growth, to weaken the yen, to help export growth, and so forth and so on. And so the government there and the new Prime Minister is simply implementing all of his pre-election promises. And no surprise to see the significant decline of the Japanese yen there, which could continue even further. I would not be surprised if we get to see the 100 yen level if the situation in Cyprus and Italy and a crisis there gets resolved. So moving forward with the top 10 events, after the Japanese Consumer Price Index on Thursday, we're going to watch the two final important economic events from the U.S. Next week, which will wrap up the trading week. The personal income and outlays on Friday, and also the consumer sentiment index to follow. Personal income and outlays is an important report, but even more important, it contains the so-called personal consumption and expenditures price index, which is the preferred measure of inflation by the Federal Reserve. Now, some will say, wait, isn't the consumer price index the preferred gauge of inflation? Consumer price index is an important gauge of inflation, but the Fed prefers this PCE price index. And the reason is because it measures a variable basket of goods and services to track changes in prices and changes in inflation. And so the household, let's see here, the personal income is expected to increase by 1% after declining by 3.6% in the previous month. And personal spending is also expected in February to increase by 0.6% month over month from 0.2% in the previous month. In other words, that would be a positive report as well from the U.S. And the core personal consumption expenditures price index is expected to increase only by 0.1% month over month, same as the 0.1% increase in the previous month. What that means is that the increase in inflationary pressures is simply not going to be strong and big enough to change the Fed's minds as far as the Fed seeing inflationary pressures rising in a significant way to prevent them from stopping their quantitative easing and other monetary policy easing operations. So that will be the implication of that report. And then the consumer sentiment index is going to be the final of the top 10 events next week. Surprisingly, the preliminary estimates showed consumer sentiment deteriorating in March to 71.8. But the number is expected to be revised higher to show a reading of 73.2. In other words, we're looking at another week of potentially positive, provided that these forecasts are accurate, of course. We are looking at another week of positive economic data from the U.S. And what I will be watching for is whether that positive U.S. economic data from the U.S. continues to help the U.S. dollar by increasing the odds that the Fed could start taking the first step towards monetary policy tightening sooner rather than later. Well, with that said, I would like to invite you to listen on a daily basis to my All Things Forex live daily broadcast, Monday through Friday on my website, allthingsforex.com. You can also follow me on Twitter at allthingsforex. Thank you all very much for attending the webinar today. Have a great day and a great weekend, and I look forward to seeing you again next Friday.